In the wake of President Donald Trump's ambitious pledge to establish the United States as the world's leading Bitcoin superpower, a growing number of U.S. university endowments and foundations are seizing the moment to invest in cryptocurrencies. This burgeoning interest in digital assets is not only reshaping the investment landscape but also sparking a broader conversation about the future and stability of cryptocurrencies as viable financial instruments. Despite their notorious volatility, cryptocurrencies have outperformed traditional asset classes over the past 5 years. This trend has prompted many institutional investors who previously adopted a wait-and-see approach to dive into the crypto pool, fearing they might miss out on significant returns. Among these pioneers is the University of Austin, which is setting the stage for a groundbreaking $5 million Bitcoin fund, marking the first initiative of its kind among U.S. endowments. Similarly, Emory University recently became the first college to disclose holdings in Bitcoin exchange-traded funds, further signaling a shift in institutional attitudes toward digital currencies. Chun Lai, chief investment officer at the Rockefeller Foundation, expressed cautious optimism about cryptocurrencies, indicating a willingness to increase their exposure should the user base diversify. "We don't have a crystal ball on how cryptocurrencies will become in 10 years, Lai noted, emphasizing the need for institutions to remain relevant in an evolving financial landscape. "We don't want to be left behind when their potential materializes dramatically." The increasing participation of endowments in the crypto market is evidenced by the significant growth of venture funds focused on digital assets. Pantera Capital, a leading player in this sector, has reported an 8-fold increase in the number of endowment and foundation clients since 2018. Notably, Yale University made early investments in cryptocurrency venture funds when Bitcoin prices were a fraction of what they are today, showcasing a long-term strategic vision. However, not all stakeholders share the same enthusiasm. Ishwar Prasad, a professor at Cornell University, has voiced concerns over the speculative nature of cryptocurrencies. "I have significant concerns about institutional investors getting into what is essentially a purely speculative financial asset," he remarked, underscoring the risks associated with high volatility in this market. As the crypto index compiled by Bitwise Asset Management has shown a staggering 64% annual gain over the past 5 years compared to 14.5% for U.S. equities, such concerns remain relevant. In tandem with the institutional rush into cryptocurrencies, the recent launch of President Trump's memecoin Dollar Trump has drawn critical attention. On its debut, the token saw rapid price fluctuations, resulting in significant profits for early investors but substantial losses for latecomers. The chaotic trading patterns have raised red flags about the integrity of such speculative assets. Investigations have revealed that many wallets associated with early trades experienced outsized gains while others faced losses exceeding $2 billion. Some analysts have likened the situation to a pump-and-dump scheme, leading to calls for increased regulatory scrutiny. As the cryptocurrency landscape continues to evolve, some financial experts remain optimistic about potential regulatory improvements that could instill greater confidence among investors. With a clearer regulatory framework, the crypto market could attract more institutional capital, potentially stabilizing prices and fostering broader adoption. Meanwhile, industry players like Brian Neal of the University of Nebraska Foundation remain cautious, holding out for more clarity before committing to digital assets. In conclusion, as the U.S. navigates its path toward clearer regulations and increased institutional interest in cryptocurrencies, the future of digital assets hangs in the balance. Will these investments solidify their place as a mainstream asset class, or will their speculative nature continue to pose significant risks? With the ongoing evolution of the crypto landscape, stakeholders will need to stay vigilant in assessing both the opportunities and challenges that lie ahead. The cryptocurrency market is experiencing a renewed surge of interest fueled by a confluence of events that could reshape the financial landscape. As Bitcoin and Ethereum continue to dominate discussions, recent developments suggest that these two titans of digital finance may soon be more accessible to mainstream investors than ever before. In a significant move, the Securities and Exchange Commission (SEC) approved the initial application by Bitwise Asset Management to create a combined Bitcoin and Ethereum exchange-traded fund ETF. This decision, announced on January 30, 2025, marks a pivotal moment in the integration of cryptocurrencies into traditional financial markets. The approval was expedited, and experts believe the final green light could arrive shortly, allowing the ETF to begin trading. This potential launch has already sparked considerable interest, with existing Bitcoin and Ethereum ETFs reportedly seeing inflows of approximately $655 million immediately following the announcement. The new ETF will offer a blended exposure to both Bitcoin and Ethereum, weighted by their respective market capitalizations. This structure is particularly appealing. It allows investors to capitalize on the perceived undervaluation of Ethereum without entirely sacrificing the conservative attributes associated with Bitcoin investments. However, analysts caution that while this development is promising, it may not lead to the dramatic price surges many investors hope for. Historical data shows that ETF approvals, while positive, have not always acted as definitive catalysts for price increases. Despite the inherent volatility in cryptocurrencies, institutional interest appears to be escalating. U.S. foundations and university endowments are increasingly building Bitcoin portfolios. The University of Austin has initiated a $5 million Bitcoin fund, the first of its kind among American endowments, while Emory University has disclosed its holdings in Bitcoin ETFs. These investments are driven by the desire to avoid missing out on the significant gains that have characterized the cryptocurrency market. The Rockefeller Foundation is also considering increasing its crypto exposure, reflecting a broader trend amongst institutional investors. "We don't have a crystal ball on how cryptocurrencies will evolve in the next decade," stated Chun Lai, the foundation's chief investment officer. "However, we don't want to be left behind when their potential materializes dramatically." This sentiment is echoed across various institutions, as many are now willing to engage with what was once considered a speculative asset class. Meanwhile, the Omnity network has introduced RichSwap, a non-custodial bridgeless automated market maker decentralized exchange (DEX) designed for trading Bitcoin runes. This platform leverages Bitcoin's security while offering a programmability toolkit that aims to enhance the DeFi landscape on the Bitcoin network. By utilizing partially signed Bitcoin transactions, PSBT's RichSwap allows users to trade without the need for custodians, thus safeguarding against potential losses from centralized exchanges. The RichSwap protocol is being positioned as a blueprint for future Bitcoin DeFi applications, emphasizing flexibility and security. Louis Liu, founder of Omnity, stated, "DPS allows one user and multiple protocols to cosign a transaction using PSBTs and broadcast it to the Bitcoin network." This innovative approach could facilitate the development of various financial products such as lending protocols and stablecoins directly on the Bitcoin blockchain. As interest in cryptocurrencies continues to grow, the identity of Bitcoin's enigmatic creator, Satoshi Nakamoto, remains a topic of intrigue. New evidence has emerged suggesting that Kraken, a major cryptocurrency exchange, may possess information regarding Nakamoto's identity linked to a specific Canadian exchange acquired by Kraken in 2016. As speculation mounts, the potential for renewed scrutiny on Nakamoto's identity coincides with Bitcoin's soaring price, which has recently surpassed $100,000. Looking forward, the evolving landscape of cryptocurrencies, characterized by institutional investments and innovative financial products, indicates that the digital asset market is transitioning into a more integrated and accepted component of the global economy. As regulatory clarity improves and technological advancements continue, the future of cryptocurrencies like Bitcoin and Ethereum seems poised for further growth and acceptance, potentially reshaping how investors engage with and perceive digital assets. In a startling turn of events in the cryptocurrency landscape, the launch of Dollar Trump, a meme coin backed by newly inaugurated President Donald Trump, has ignited a whirlwind of speculation, profit and loss among investors. Just 3 days before his inauguration, Trump introduced the coin that surged dramatically from $7 to a staggering $75 in a matter of hours. This meteoric rise was short-lived, however, as the price plummeted to around $40 shortly thereafter, coinciding with the launch of another meme coin, $Melania, by First Lady Melania Trump. Even the pastor at Trump's inauguration, Lorenzo Sewell, entered the fray, promoting his own token, Lorenzo. Meme coins, characterized by their humorous origins and often rooted in viral internet culture, have exploded in popularity, with Trump being the latest addition to a growing list. According to Simon Peters, a crypto analyst at eToro, these tokens are typically easy to create and operate on existing blockchains, requiring minimal technical expertise, while they offer the allure of quick financial gain. Peters warns that the reality is starkly different. The vast majority of people lose money. The phenomenon is reminiscent of previous speculative bubbles in the crypto space, and experts draw parallels between meme coins and the NFT craze of 2021. Carol Alexander, a finance professor at Sussex University, highlights the allure of these coins for a demographic of young men seeking quick riches, likening their appeal to a form of gambling devoid of tangible backing. They're basically a form of gambling, an amped-up version of the stock market but with less connection to anything concrete, asserts Mike Hearn, an early Bitcoin developer. The volatility of meme coins is exacerbated by the lack of regulation in the crypto space, which has led to a surge in schemes such as pump and dump. Investors, often less experienced, are left vulnerable as creators hype their coins on social media before selling off their holdings and crashing the price. The recent spike in meme coin activity has raised alarms among regulators, who caution that many of these ventures are designed to exploit unsuspecting investors. The initial frenzy surrounding Trump resulted in a mix of fortunes. Some savvy early traders reportedly made tens of millions in profits, while a staggering number of subsequent investors have reported losses exceeding $2 billion. Chainalysis, a crypto forensics firm, indicated that over 810,000 wallets were in the red, with some individuals expressing frustration and disappointment at their investment decisions. Amidst the chaos, the Trump family has benefited significantly from the meme coin craze. Trading fees from the Trump token alone have reportedly netted nearly $100 million for the family. Critics argue that Trump is leveraging his political position to profit from the speculative frenzy, all while potentially rolling back regulatory measures aimed at protecting investors. Corey Freyer, a former crypto advisor at the SEC, commented, "The president is participating in shady crypto schemes that harm investors, while at the same time appointing financial regulators who will roll back protections for victims." The implications of this new wave of meme coins extend beyond individual investors. As Trump seeks to position the U.S. as a leading player in the crypto space, he has also filed to launch a Bitcoin exchange-traded fund under his Truth.fi brand. This move reflects a strategic effort to capitalize on the growing interest in digital assets, aligning with his campaign promises to make the U.S. the crypto capital of the planet. As the market adapts to this new reality, the future of meme coins remains uncertain. While they promise the potential for substantial returns, the inherent risks and the unregulated nature of the market continue to pose significant challenges for everyday investors. The trajectory of Trump alongside an ever-expanding roster of meme coins serves as a cautionary tale in the rapidly evolving world of cryptocurrency, where fortunes can change in the blink of an eye. As the dust settles from this latest frenzy, it remains to be seen whether these digital assets will stabilize or if they will continue to be a source of volatile speculation. The cryptocurrency market remains a dynamic landscape characterized by rapid developments and shifting investor sentiment. Recently, a significant event has emerged that may prompt investors to consider allocating funds toward Bitcoin and Ethereum. The U.S. Securities and Exchange Commission (SEC) approved the initial phase of a combined Bitcoin and Ethereum exchange-traded fund ETF, a move that could enhance the appeal of these two leading cryptocurrencies. As of February 9, 2025 Bitcoin's market cap stands at approximately $1.9 trillion, while Ethereum holds a market cap of around $320 billion, reflecting their substantial presence in the digital asset landscape. The approval granted to Bitwise Asset Management on January 30 signals the potential for a new financial instrument that could integrate these cryptocurrencies further into the traditional financial sector. Following the announcement, existing ETFs focusing solely on Bitcoin or Ethereum experienced a notable influx of approximately $655 million, indicating strong institutional interest. This trend suggests that investors are optimistic about the forthcoming ETF's ability to drive demand for both assets, although the extent of this impact remains uncertain. As the proposed ETF will be weighted according to the market capitalizations of Bitcoin and Ethereum, it is poised to reflect Bitcoin's performance more closely than Ethereum's. This structure may provide a compelling investment opportunity for those looking to benefit from Ethereum's relative undervaluation without fully sacrificing the perceived stability associated with Bitcoin. However, seasoned investors caution that while the ETF's introduction is a positive development, it is unlikely to serve as a definitive catalyst for price surges. Historical trends show that ETF approvals have not consistently translated into immediate price gains, as evidenced by Ethereum's price action after the launch of its standalone ETFs last July. Compounding the current investment landscape, on-chain data suggests a marked increase in accumulation among Ethereum addresses, with a staggering $883 million in inflows recorded recently. This influx indicates that long-term investors are viewing the current dip in prices as an attractive buying opportunity. Despite Ethereum's recent struggles, where it has seen a 14% drop over the past week, this accumulation trend could signal a potential recovery as supply on exchanges diminishes. Observers note that a decrease in exchange reserves typically correlates with a tightening supply, which could bolster prices in the future. However, as the market grapples with volatility, analysts advise caution. The technical indicators suggest that Ethereum might face further declines, targeting the $2,350 support level after breaching critical moving averages. While the market dynamics suggest potential for recovery, it is essential for investors to approach with realistic expectations. A modest investment of around $1,000 in Bitcoin or Ethereum may be wise for those planning to hold these assets for the long term, particularly as the ETF begins trading and additional products may emerge in the market. In conclusion, as the cryptocurrency sector evolves, the intersection of regulatory developments and market behavior continues to shape investment strategies. The approval of a combined Bitcoin and Ethereum ETF presents a significant opportunity for investors, yet careful consideration of market conditions and individual risk tolerance remains paramount. As institutional interest grows and on-chain metrics reveal accumulating support, the coming months may prove pivotal for both Bitcoin and Ethereum, potentially laying the groundwork for future growth within this innovative asset class. In a significant turn of events within the cryptocurrency landscape, the U.S. Securities and Exchange Commission (SEC) has initiated a process that could see Solana (SOL) becoming the next cryptocurrency to have an exchange-traded fund ETF approved, following in the footsteps of Bitcoin and Ethereum. This development comes as a surprise, particularly given the SEC's previously stringent stance on cryptocurrency regulation, which has often labeled Solana as an unregistered security. The announcement not only signals a potential shift in regulatory attitudes but also positions Solana as a frontrunner in the altcoin market. The SEC's decision to begin a formal review of Grayscale's recent ETF application for Solana marks a pivotal moment. According to analyst Eric Balchunas, the cryptocurrency sector is now navigating in uncharted territory. The SEC's move, which includes a set deadline for a decision by October 11, is noteworthy because it indicates a reconsideration of Solana's classification and legitimacy. As Matthew Ney from Messari aptly observes, Solana has shifted from a toxic asset to a magnet for Wall Street, underscoring the changing perceptions among institutional investors. This renewed interest in Solana is backed by impressive metrics. The network reported a staggering 318% increase in real economic value within a single quarter, alongside a market capitalization nearing $91 billion. Such figures are not just numbers, they represent a resurgence in confidence in Solana's potential as a viable investment option. Furthermore, with the Solana blockchain now recognized for its vibrant ecosystem, home to numerous decentralized applications and robust validator revenues, the potential approval of an ETF could serve as a catalyst for even more substantial growth. However, the path to ETF approval is fraught with challenges. The SEC's review will unfold over a 5-phase process which could take up to 240 days, and any unfavorable outcome may lead to lawsuits reminiscent of the legal battles seen in the Grayscale vs. SEC case in 2023. If Solana were to succeed, it could set a precedent not only for itself but for other altcoins currently languishing under regulatory scrutiny. James Seifert emphasizes that the review process represents a positive sign for exchanges in litigation, with the SEC suggesting a broader potential for altcoins to emerge from the shadows. While Solana's prospects appear bright, the wider cryptocurrency market remains volatile. Following a bullish start to the year, both Solana and Ethereum have faced price corrections, with SOL seeing a recent decline of 14.74% and ETH down 19.02%. This downturn has opened the door for newer entrants in the space such as Remitix RTX, which has been gaining traction as a solution for cross-border transactions, highlighting the ongoing competition for market dominance. As Solana and Ethereum grapple with their immediate challenges, the potential approval of a Solana ETF could herald a new era for the cryptocurrency landscape, one where institutional investment and mainstream acceptance become increasingly intertwined. Investors and enthusiasts alike will be watching closely as the SEC's decision approaches, with implications that may reach far beyond just Solana, influencing the fate of many altcoins eager for legitimacy in the market. In conclusion, the unfolding developments surrounding Solana present both opportunities and challenges within the cryptocurrency sector. The SEC's decision to review the ETF application signifies a critical moment that could redefine the regulatory landscape and alter how cryptocurrencies are perceived by institutional investors. As the market awaits the outcome, it is clear that Solana is poised to play a crucial role in shaping the future of altcoin investments.